Ever looked at your tax forms and just felt your eyes glaze over at the word deductions?
Or maybe heard friends talking about itemizing versus the standard deduction and kind of nodded along hoping nobody asked you to explain it.
Huh. Yeah, you're definitely not alone there. It can feel like a whole different language sometimes.
It really can. Taxes are complex and, figuring out deductions is often that first big hurdle to feeling a bit more in control.
Exactly. And that's why we're here. Welcome to the deep dive. We take these complicated topics, things like tax deductions, and, well, we break them down into something you can actually use.
Today, we're diving into that world. We'll unpack the big choice, standard deduction versus itemizing. Then we'll get into the nitty-gritty of some common itemized deductions.
Our goal is pretty simple. Help you understand how these work, why they matter so much, and maybe point out a few surprising details along the way.
Sound good?
Sounds great.
Huh.
Okay, let's unpack this. Where do we start? That fundamental choice, right?
Yeah,
Standard or itemized?
that's the one. Basically, when you file, you generally have to pick one path, standard deduction or itemized deductions.
And the goal is to pick whichever one lowers your taxable income more. Simple as that.
Pretty much. The standard deduction is like a flat amount the IRS gives you. No need to track specific expenses for this one. If you don't itemize, you take the standard.
And that amount isn't the same for everyone, is it?
No, it changes based on how you file. For 2023 taxes, if you're single, it was $13,850.
Okay.
Filing as head of household, that jumps to $20,800.
Right.
And for married couples filing jointly, or a qualifying surviving spouse, it's $27,700.
And married filing separately.
That's $13,850, same as single. But there's a catch. If you file separately and one spouse itemizes their deductions.
The other one has itemized too, right? You can't have one take standard and the other itemized.
Exactly. It's got to be consistent for that couple.
Okay, but that's not the whole story for the standard deduction, is it? I feel like there's more.
Mm-hmm.
Something about age or blindness.
You got it. This is where it gets a bit more interesting and potentially more beneficial for some folks. There's an additional standard deduction amount if you're 65 or older, or if you're legally blind.
So it's like an extra boost on top of the regular amount.
Precisely. It recognizes, potentially different circumstances or needs.
How much extra are we talking?
Well, if you're unmarried, so single or head of household, and you meet one condition, either 65 plus or blind, you get an extra $8,850 for 2023.
Okay. And if you're both 65 and blind.
Then it doubles, an extra $3,700 for unmarried folks in that situation.
And for married couples.
The amounts are slightly different. For a married individual, it's an extra $1,500 for one condition.
Per person.
To a qualifying person, yeah. So if one spouse is, say, 67, they add $1,500 to the couple's standard deduction. If that same spouse was also blind, their additional amount would be $3,000.
Wow. Okay. So if both people filing jointly qualify.
It adds up. Let's say both spouses are 65 or older. That's $1,500 each, so an extra $3,000 total on top of their $27,700 base. And if, hypothetically, both spouses were 65 and both were blind, that'd be an extra $6,000 total. $3,000 each.
That can make a real difference. Can we maybe walk through an example?
Sure. Let's take Bob and Suzanne DeFilippis. They're both 66, filing jointly for 2023. Their base standard deduction is $27,700.
Okay.
Since they're both over 65, they each get that extra $1,500 bump.
So $1,500 plus $1,500 ours is $3,000 extra.
Right. So their total standard deduction is $27,700 plus $3,000. Which comes out to $30,700.
See, that's way more than just the base amount. Good example.
Or think about Ed Joback. Single taxpayer, and he's blind, let's say for 2023.
Okay.
If Ed is under 65, his standard deduction is the base $13,850 plus that extra $8,850 for blindness. So $15,700.
Right.
But if Ed is 65 or older and blind, he gets the base plus the double bump. That's $3,700. So his total would be $17,550.
It really pays to know about these extra amounts. What about dependents? Can someone claimed as a dependent take a standard deduction?
Yes, but the rules are different. For 2023, a dependent's standard deduction is generally the greater of $1,250 or their earned income plus $400.
Earned income, like from a part-time job.
Exactly. So say a dependent earned $1,300 from a summer job. Their earned income plus $400 is $1,700. That's greater than $1,250, so their standard deduction would be $1,700.
Okay, that makes sense. And can dependents also get the extra amount for being 65 or blind?
Yes, they can. Those additional amounts apply to dependents too, following the same rules based on their own age or blindness.
Right, so that's the standard deduction covered pretty well, I think. Lots of nuances there.
Yeah.
Now let's flip the coin. Itemized deductions.
Right. So instead of taking that fixed standard amount, you can choose to itemize. This means listing out specific eligible expenses on your tax return specifically on Schedule A of Form 1040.
And you'd only do this
If the total of all those specific itemized deductions adds up to more than your standard deduction amount.
whichever path saves you more tax.
That's the name of the game. If your itemized total is higher, you generally choose to itemize. If your standard deduction is higher, you stick with that.
And just to reiterate that rule for married filing separately.
Yep. If one itemizes, the other must itemize as well. No mixing allowed for that filing status.
Got it. Okay, so what kind of things can you itemize? Let's dig into some of the big categories. Maybe start with medical expenses. That seems like a common one.
It is, but the rules can be tricky. You can potentially deduct payments for medical care for yourself, your spouse, or a dependent.
And is the definition of a dependent for medical expenses the same as for claiming someone on your return?
Good question. It's actually a bit broader here. For medical expenses, you can include costs for someone if you provided more than half their support, even if you can't claim them as a dependent for other reasons, like maybe they had too much gross income or filed a joint return.
Oh, that is interesting. So you might be able to deduct medical costs for, say, an aging parent you support, even if they don't technically qualify as your dependent overall.
Potentially, yes. It's a nuance worth knowing.
And when do you deduct these? Is it when the bill comes or when you pay?
It's generally when you pay. So costs paid by cash or check during the year count for that year. And if you charge it to a credit card,
Like a hospital bill.
exactly, you deduct it in the year you charge it, not necessarily when you pay off the credit card bill later.
Okay. What about payments for someone who sadly passed away?
Payments made for a deceased spouse, for example, are deductible in the year those payments are actually made.
Now, the calculation, this is where that AGI floor comes in, right?
Yes, the 7.5% AGI floor. This is absolutely crucial. But before you even think about that floor, you have to subtract any insurance reimbursements you received.
Okay, so step one, total qualified medical expenses.
Yeah.
Step two, subtract what insurance paid back.
Correct. Then take that net amount and subtract 7.5% of your adjusted gross income, AGI.
And only the amount above that 7.5% threshold is actually deductible.
That's right. So if your AGI is $100,000, the floor is $7,500. If your net medical expenses after insurance were $10,000, you could deduct $2,500. $10,000 minus $7,500.
Got it. So what kind of expenses typically count? It's more than just doctor's visits, I assume.
Oh, yeah. Medicine, prescription drugs, including those Medicare Part D premiums, doctor bills, obviously, medical and accident insurance premiums.
Can that include premiums for long-term care insurance?
Yes, qualified long-term care premiums can count, but the deductible amount is often limited based on your age. Medically necessary surgeries, absolutely.
What about getting to the doctor?
Transportation, primarily for and essential to medical care counts. You can deduct your actual costs, like gas and oil, or use a standard mileage rate. For 2023, it was 22 cents per mile, plus tolls and parking.
Interesting. Anything else surprising?
Well, costs for physically disabled individuals to remove structural barriers in their homes, think like installing ramps or widening doorways for wheelchair access, those can qualify as medical expenses too.
But that's really good to know.
Yeah.
But what about things that definitely don't count?
Right, the no list. Elective cosmetic surgery is generally out, unless it's needed because of, say, an accident or a deformity.
So purely cosmetic stuff is a no.
Correct. Also, illegal drugs, obviously. General travel, vitamins, nutritional supplements, unless specifically prescribed by a doctor for a medical condition. The Medicare tax you pay through Social Security doesn't count.
Funerals? Cemetery lots?
No, those aren't deductible as medical expenses. Life insurance premiums, insurance against lost earnings, general health club dues. Nope. And basic personal hygiene things like toothpaste or over-the-counter stuff usually don't count either.
Okay, clear enough. What about those insurance reimbursements? You mentioned subtracting them. What if insurance, or maybe an employer, pays you back more than you spent?
Good point. If an employer reimbursement exceeds your total medical expenses, that excess amount is actually considered taxable income to you.
Okay. And what if you get reimbursed this year for an expense you deducted last year.
Then that reimbursement becomes taxable income in the year you receive it. It's called the tax benefit rule, basically. You got a tax break last year, so if you get the money back this year, you need to account for it now.
That makes sense. It prevents getting a double benefit, right? Deducting it and getting the money back tax-free.
Exactly. The IRS is pretty careful about making sure that doesn't happen.
Okay, let's switch gears. State and local taxes, or SALT. That's another big itemized deduction category.
It is, or at least it used to be much bigger for some people.
Mm.
For most of us, cash basis taxpayers, you deduct these in the year you actually pay them.
But the huge thing here now is that cap, isn't it?
That's the elephant in the room, yes. The Tax Cuts and Jobs Act put a limit on the SALT deduction. Your total itemized deduction for state and local income taxes, or state and local sales taxes, you have to choose one, PLUS state and local property taxes is capped at $10,000 per household per year.
Just $10,000 total for all of those combined.
$10,000 total, or $5,000 if you're married, filing separately. This was a major change and significantly reduced the benefit for people in states with high income and property taxes.
Yeah, I can see how that would hit hard. What about foreign property taxes?
Foreign real estate taxes are generally only deductible if the property is used in a trade or business, not for personal use property abroad.
Okay. Let's break down the types of taxes within that $10,000 cap. Real estate taxes first.
Right. You have to be legally obligated to pay them. If you buy or sell property during the year, the taxes need to be prorated between the buyer and seller based on how long each owned it.
What if you pay taxes under protest, like you're disputing the amount?
You can still deduct them in the year paid, even if you're protesting.
But things like special assessments for sidewalks or sewers, those aren't deductible.
Correct. Those are generally seen as increasing the value of your property, so they're added to your property's cost basis, not deducted as taxes.
Okay. What about personal property taxes, like on a car?
Yes, those can be deductible, but only if the tax is based on the value of the property, what's called an ad valorem tax, and it has to be imposed annually. Many state vehicle registration fees are partly based on value and partly a flat fee. Only the value-based part is deductible as a personal property tax.
Got it. And then there's income taxes or sales taxes.
Right. For income taxes, you can deduct state and local income taxes that were withheld from your paychecks during the year, any estimated tax payments you made, and any amount you paid in the current year for a prior year's state or local income tax liability.
What if you get a state tax refund?
If you itemize deductions in the year you paid that tax, then the refund you receive later is generally considered taxable income in the year you get it, again, due to the tax benefit rule.
And you mentioned a choice between income tax and sales tax.
Yes. You can elect to deduct either your state and local income taxes or your state and local general sales taxes. You can't deduct both.
How do you figure out the sales tax deduction if you act like you keep every receipt?
You can use your actual expenses if you have meticulous records, but most people use the optional sales tax tables provided by the IRS. These tables give you an amount based on your income and state of residence. Plus, you can add the actual sales tax you paid on certain large purchases, like a motor vehicle, boat, or major home renovations.
So you'd compare your total state local income tax paid versus the sales tax amount, either actual or from the tables plus big items, and deduct whichever is higher, subject to that overall $10,000 SALT cap.
Precisely. Choose the one that gives you the bigger deduction within the limit.
And just to be clear, what taxes are definitely not deductible here on Schedule A?
Federal taxes are never deductible on your federal return. So federal income tax, Social Security and Medicare taxes, FICA, federal excise taxes, none of those. State inheritance taxes are also not deductible as SALT. And as we touched on, taxes related to a business or rental property usually go on Schedule C or Schedule E, not Schedule A.
Okay, that covers SALT pretty well. Another potentially big one is interest expense, but I feel like this one has a lot of different categories too.
It definitely does. Not all interest is treated the same by the tax code. Let's start with home mortgage interest.
The interest you pay on your home loan.
Yes. It's generally deductible on your main home, your principal residence, and one other home. That second home could be a vacation house, for example.
Are there limits?
Oh, yes. For mortgages taken out after December 15th, 2017, you can generally only deduct the interest on up to $750,000 of home acquisition debt. That's debt used to buy, build, or substantially improve your qualified home, and it must be secured by that home.
$750,000 total between the main home and the second home.
Yes, combined. And if you're married filing separately, that limit is halved to $375,000. Mortgages taken out before that date might have a higher limit, usually $1 million.
What about points you pay when you get a mortgage?
Points, which are basically prepaid interest paid when you buy or build your main home, are generally fully deductible in the year you pay them, if certain conditions are met. But points paid to refinance a mortgage usually have to be deducted evenly over the life of the new loan.
Okay, so that's home mortgage interest. What about interest on money you borrow to invest? Investment interest.
Right, investment interest expense. This is deductible, but it's limited to your net taxable investment income for the year.
Net taxable investment income.
Yeah,
What does that include?
things like interest income, non-qualified dividends, royalties, minus related expenses, short-term capital gains. You can also elect to include long-term capital gains and qualified dividends here, but if you do, you give up the lower preferential tax rates on them.
So you can't deduct more investment interest than you actually earned in investment income.
Pretty much. Think of it like gambling losses. You can deduct them up to your winnings, but no more. You can't create a net investment loss using the interest deduction.
What if you pay more interest than you have income? Is it just lost?
No, that's the good news here. Any investment interest expense you paid but couldn't deduct because of the income limitation can be carried forward indefinitely to future years.
Oh, okay. So you might get to deduct it later when you have more investment income.
Exactly. One key exclusion, though. You can't deduct interest expense incurred to purchase or carry tax-free investments like municipal bonds. Since the income isn't taxed, the expense to earn it isn't deductible.
Makes sense. Now, the big category for most people's everyday borrowing, personal interest.
And this is generally the big no. Personal interest, sometimes called consumer interest, is typically not deductible.
What falls under personal interest?
Things like interest on credit card debt, car loans, personal loans from a bank, loans against life insurance policies, interest on federal or state income tax underpayments.
What about home equity loans? Didn't those used to be deductible?
They did, but the rules changed. Now, interest on a home equity loan or line of credit is only deductible if the loan proceeds were used to buy, build, or substantially improve the home that secures the loan. And D, it has to fit within those overall mortgage debt limits, $750 sirs. If you use a home equity loan for, say, paying off credit cards or taking a vacation, that interest is generally not deductible anymore.
Wow, that's a critical distinction. So personal interest, mostly a no-go.
Mostly a no-go.
What about paying interest in advance, like prepaying next year's mortgage interest?
Even if you're a cash basis taxpayer, prepaid interest generally has to be allocated to the tax year to which it applies. You can't just deduct it all up front when you pay it. You deduct it over the period of the loan it covers.
Okay. One more interest type. Student loan interest. Where does that fit?
That's a special case. Student loan interest is not an itemized deduction. It's actually an above-the-line deduction, or what the IRS calls an adjustment to income.
Meaning you can take it even if you don't itemize.
Exactly. It reduces your adjusted gross income directly. There are income limitations and a maximum deduction amount, $2,500 per return per year, but it's separate from Schedule A itemized deductions.
Good clarification. All right, let's move on to something maybe a bit more uplifting. Charitable contributions.
Yes, giving back can also give you a tax deduction. Generally, you can deduct contributions you make to qualified charitable organizations.
Keyword there being qualified, right? Like a
Yeah.
registered 501c charity.
Precisely. You can usually check an organization's status on the IRS website. What's not deductible are gifts made directly to individuals, no matter how needy they are.
Political contributions.
Also not deductible as charitable contributions.
Okay. Now, how much can you deduct? Does it matter if you give cash versus, say, donating old clothes or stock?
It matters quite a bit. For cash contributions, it's pretty straightforward. You deduct the amount you gave, subject to certain limits. For property donations, it gets more complex.
How so?
It depends on the type of property. If you donate ordinary income property, think inventory from a business, short-term capital assets, or property that has decreased in value, your deduction is limited to the lesser of its fair market value or its adjusted basis, usually what you paid for it.
So if you donate clothes you bought for $200 that are now worth $50, you deduct $50. If you donate stock you bought for $1,000 2 months ago that's now worth $800, you deduct $800.
Correct. You don't get a deduction for more than it's currently worth if it's lost value or if it's short-term ordinary income property.
Okay, what about appreciated property held long-term, like stock you've owned for years that's gone up in value?
That's long-term capital gain property. For donations of this type of property held more than a year to public charities, you can generally deduct the full fair market value at the time of the donation.
Without having to pay capital gains tax on the appreciation.
Exactly. That's often a very tax-efficient way to give, especially for highly appreciated assets.
But there are limits based on your income, right? These AGI limitations.
Yes, and they get pretty nuanced. The maximum amount you can deduct for charitable contributions in a year is based on a percentage of your adjusted gross income, AGI. For cash contributions to public charities, the limit is typically 60% of your AGI.
60%, that's quite high.
It is. For donations of ordinary income property, the limit is usually 50% of AGI. And for donations of long-term capital gain property, it's often limited to 30% of AGI, or sometimes 20% for donations to certain private foundations.
Wow, okay. So different limits for different types of donations. Is there an order you apply these limits?
Yes, there's a specific order. You apply the 60% limit for cash first, then the 50% limit for ordinary income property, and finally the 30%, 20% limits for capital gain property. It can get complicated if you make multiple types of donations.
What happens if your donations exceed those AGI limits in 1 year?
You don't necessarily lose the deduction. Excess contributions that you can't deduct in the current year due to AGI limits can generally be carried forward for up to 5 years.
Ah, okay. So you might be able to use that excess deduction in a future year.
Right. Let's maybe try an example to make this clearer.
Please. Examples always help.
Okay, imagine Joe Kelly. His AGI is $100,000. In 2023, he gives $15,000 cash to the United Way, a public charity.
Okay, cash to a public charity. Limit is 60% of AGI, so $60,000. He's well under that.
Right, so that $15,000 cash is fully deductible right now. He also donates some old furniture to Goodwill. It cost him $1,000 years ago. Its fair market value now is maybe $10,000. Oh, wait, let me check the outline. Yes, FMV, $10,000. This is ordinary income property.
Okay, ordinary income property. The limit is usually 50% of AGI, so $50,000. But wait, didn't we use up some AGI limit with the cash? Or how does that work?
Good question. The limits are layered. The overall limit for donations to public charities is 60% of AGI, $60K for Joe. His cash used $15 of that. The 50% limit applies specifically to OI property, but it can't exceed the remaining overall 60% limit. So his $10K furniture donation fits easily within the remaining $45K, $6K, $15K overall limit, and also within the 50% limit. So he deducts the full $10 for the furniture.
Okay, so far, $15 cash plus $10K furniture equals $25K deducted. What else did Joe do?
He also donated a sculpture he owned for many years to an art museum. It's long-term capital gain property with a fair market value of $30,000.
Okay, LTCG property to a public charity. That usually has a 30% of AGI limit, right? So 30% of $100,000 now is $30,000.
Right, but remember the overall 60% limit. He's already deducted $25,000, $15K cash plus $10 furniture. The total he can deduct to public charities this year is capped at $60,000. So he has $35,000 of room left, $60K, $25K.
Ah, okay. So his sculpture donation is $30,000 FMV. The specific limit for LTCG property is $30,000, 30% AGI, and he has $35,000 of room left under the overall 60% limit. So does he deduct the full $30 for the sculpture?
In this case, yes. The $30,000 donation fits within both the 30% specific limit and the remaining overall 60% limit. So his total deduction is $15 plus $10 plus $30K equals $55,000. Let me recheck the outline's example calculation. The outline suggested a $5K carry forward, implying only $25K of the sculpture was deductible. Let's rethink that 30% limit interaction.
Maybe the 30% limit applies after considering the other donations somehow.
Let's reconsider the order. 1. Cash. $15K used, limit $60K. Remaining overall room. $45K, 2 cents. OI property. $10K used, limit $50K, but can't exceed remaining $45K overall room. Total used, $25K. Remaining overall room, $35K. 3 cents, LTCG property, $30K donation. Specific limit is 30% AGI equals $30K. It also fits within the remaining $35K overall room. Okay, my initial walkthrough seems correct, allowing the full $30K. The outline's conclusion of a carry forward might be based on a slightly different interpretation, or perhaps a detail we missed. For clarity, let's stick to the principle. Apply limits sequentially, 60% cash, 50% OI, 30% LTCG, ensuring the specific type limits and the overall 60% limit aren't breached. In this scenario, it seems the full $30K sculpture could be deducted, totaling $55K. Let's assume that for now. The key takeaway is that these limits interact.
Okay, it definitely highlights the complexity. What if you get something back for your donation, like attending a charity dinner?
Good point. If you receive a benefit in return for your contribution, you can only deduct the amount of your contribution that exceeds the value of the benefit you received.
So if the dinner ticket costs $200, but the actual value of the meal and event is $75, You can only deduct $125.
Exactly. And things like buying raffle tickets from a charity are generally not deductible at all because you're getting a chance to win something in return.
Makes sense. What about timing? When is a donation deductible?
Cash or checks are deductible when they are delivered or mailed. Credit card donations are deductible in the year the charge is made, even if you pay the bill next year.
Can you deduct expenses if you volunteer your time? Like driving for Meals on Wheels?
You can't deduct the value of your time, but you can deduct your out-of-pocket expenses incurred while performing services for a charity. This includes the cost of gas and oil for your car, or you can use the standard charitable mileage rate, which was 14 cents per mile for 2023, plus tolls and parking fees.
Okay. And I remember reading something about hosting a student.
Yeah, that's a less common one. If you have a student not beyond 12th grade living in your home under a written agreement with a qualified organization as part of a program to provide educational opportunities, you may be able to deduct up to $50 per month for each full month the student lives with you.
Interesting. Finally, record keeping. I assume that's important.
Crucial. You need records for all cash contributions, like a bank statement or written confirmation from the charity. For non-cash property donations over $500, you need to file Form A283. And for donations of property valued over $5,000, other than publicly traded securities, you generally need a formal written appraisal.
Keep your receipts and acknowledgments.
Absolutely. The IRS wants proof.
Okay, moving on. Casualty losses. This sounds dramatic. Are these common deductions?
They used to be more common, but the rules got much stricter recently for personal losses. For non-business property, casualty and theft losses are now only deductible if the loss occurred in a presidentially declared disaster area.
Wow, only in a federally declared disaster. That narrows it down significantly.
It really does. So damage from a typical house fire or a tree falling on your car in a storm usually wouldn't qualify unless it happened as part of a larger declared disaster.
If it does qualify, how do you calculate the loss?
You take the smaller of either the decrease in the property's fair market value caused by the disaster or your adjusted basis in the property, usually what you paid for it, plus improvements minus depreciation if applicable.
Okay, the smaller of those two numbers. Then what?
Then you have to subtract any insurance proceeds or other reimbursements you received or expect to receive.
Right, no double dipping.
Exactly. After subtracting insurance, there are two more hurdles. First, you have to reduce each separate casualty loss event by $100. This is a per-event floor.
Okay, subtract $100 per disaster event.
Then, after applying the $100 floor to each event, you add up all your net casualty losses for the year, and you can only deduct the amount that exceeds 10% of your adjusted gross income, AGI.
Wow, another AGI floor and a high one at 10%. So let's say your AGI is $100,000. You have one disaster loss, net of insurance is $15,000. You subtract $100, leaving $14,900. Then you subtract 10% of your AGI, which is $10,000. So you could only deduct $4,900.
That's exactly right. It has to be a pretty significant uninsured loss relative to your income to get much of a deduction.
Now, what if you could have filed an insurance claim but didn't?
Generally, if the loss was covered by insurance, you cannot deduct the loss unless you file a timely insurance claim. You can't choose to just take the tax deduction instead of filing a claim.
Okay, and just losing something or breaking it accidentally doesn't count?
No. Lost, misplaced, or accidentally broken property is not a casualty loss. It has to be damage from an identifiable event that is sudden, unexpected, or unusual, and for personal losses now, within that disaster area context.
Got it. Very restrictive now. What about those miscellaneous deductions we used to hear about, like unreimbursed employee expenses?
Yes. Most of those miscellaneous itemized deductions that were subject to a 2% of AGI floor, things like unreimbursed employee business expenses, tax prep fees, investment expenses, those were suspended by the Tax Cuts and Jobs Act for tax years 2018 through 2025.
So for now, those are mostly gone.
For federal purposes, yes. Some states might still allow them on the state return, but not federally.
Okay. One last specific one. Gambling losses.
You're right. Gambling losses are deductible as an itemized deduction, but there's a very important limit.
Let me guess. You can only deduct them up to the amount of your gambling winnings.
You got it. You report all your gambling winnings as income. Then you can deduct your gambling losses, but only up to the total amount of winnings you reported. You can't use gambling losses to reduce your other taxable income or create a net tax loss.
So if you win $1,000 and lose $5,000, you report $1,000 income and can deduct $1,000 in losses, basically netting out the gambling activity itself, but you can't use the other $4,000 loss against your salary income.
Exactly. The deduction just cancels out the reported winnings, up to the amount of those winnings.
Okay, that's a lot of detail on specific deductions. Maybe we can tie it together with that case study. Alice Adams.
Yeah, looking at changes year over year can be really insightful. So, Alice Adams, single taxpayer, her AGI went from $85,000 in year one to $100,000 in year two, and her itemized deductions jumped quite a bit.
What changed specifically?
Well, her medical expense deduction went from $0 in year one to $5,000 in year two.
Okay, $5,000 medical deduction in year 2. With her AGI at $100,000, we know the floor is 7.5% of that, so $7,500.
Right. So for her to get a $5,000 deduction, her actual qualified medical expenses after any insurance must have been $5,000 plus the $7,500 floor. So $12,500 in total out-of-pocket costs.
Wow, $12,500 is a lot. That's a big jump from $0 deductible the year before. As a tax preparer, what would that make you think?
It definitely raises a question. Was there a major medical event? Significant surgery? Did her insurance coverage change? And crucially, was this calculation done correctly, subtracting insurance first? You definitely want to verify the details behind that $12,500 figure.
Makes sense. What else changed for Alice?
Her real estate taxes went up from $3,000 to $5,500.
Okay, an increase, but still well under the $10K SALT cap.
Right, and her home mortgage interest also jumped significantly from $5,500 in year one to $8,500 in year two.
Higher property taxes and higher mortgage interest in the same year. What might that suggest?
It strongly suggests she might have bought a new home in year two, likely a more expensive one. Or perhaps she refinanced her existing mortgage and maybe took out home equity debt for substantial home improvements, which would also increase the deductible interest.
So those two changes together tell a story.
They often do. You'd want to confirm that story new
Such
purchase. Refinance, home improvement loan, make sure the interest relates to qualifying debt.
What else jumped out?
Charitable contributions went from $1,000 in year one to $10,000 in year two.
Whoa, that's a tenfold increase. What's the first thought there?
Honestly, the first thought is often, is that a typo? Maybe an extra zero got added during data entry. You see that sometimes.
The slip of a finger.
Exactly. So you'd absolutely need to verify. Ask Alice, check the donation receipts or acknowledgement letters. It could be a genuine large contribution. Maybe she donated stock or made a large cash pledge, but a jump that big warrants immediate confirmation.
So this whole Alice Adams example really shows how looking at the changes in deductions and how they relate to each other can help spot potential issues or understand major life events that impact taxes.
Precisely. It's about more than just numbers. It's about the financial narrative. Did something big happen? Does the tax return reflect that accurately? It also highlights why keeping good records throughout the year is so important, not just for proof, but for understanding your own financial picture.
Yeah, tracking these things as they happen makes tax time much less of a scramble and helps you plan better too.
Absolutely. Diligence pays off.
Okay, so we've covered a lot of ground. We went through that fundamental choice standard versus itemized.
Talked about those extra bumps to the standard deduction for age and blindness.
Dove into medical expenses, that tricky 7.5% AGI floor, and what counts.
Navigated the $10,000 SALT cap on state and local taxes.
Untangled the different types of interest, mortgage, investment, and that non-deductible personal interest.
Explored the complexities of charitable donations, cash, property, AGI limits, carryovers.
And touched on those very specific rules for casualty losses and gambling losses.
It's a lot, but understanding these pieces really does matter.
Why does it matter so much beyond just potentially lowering your tax bill come April?
Because it empowers you to make more informed financial decisions all year long. Knowing that mortgage interest on acquisition debt is deductible might influence your decision to buy versus rent. Understanding the benefit of donating appreciated stock might change how you approach charitable giving. Knowing the SALT cap might impact where you choose to live or how you view state versus local tax initiatives.
So it connects directly to financial planning and everyday choices.
Absolutely. It's not just about looking backward at tax time. It's about using that knowledge to plan forward.
So as you, our listener, think about your own situation, your own expenses, how might understanding these deduction categories change how you track things, or even how you plan your spending or giving?
Yeah. What's the one surprising thing you learned today that might stick with you? Was it the detail about medical dependence? The SALT cap, the non-deductibility of most personal interests?
Think about that. How could knowing just one of these details maybe shift your perspective or your financial strategy even just a little bit, something to definitely mull over?